Global markets are on edge as Wall Street slides. The RBA faces renewed inflation pressures and key legal and corporate decisions dominate the headlines. Let's head to London now. We're joined by Kyle Rodda from Capital.com. The sell-off on Wall Street grabbed a lot of attention this week. What's actually behind it from your perspective?
Well, I think there's two things, and it's not a really kind of clear catalyst, but if you sort of look close enough, it's definitely there. Last week, the Fed's language when it comes to the interest rate outlook and effectively the warning that further interest rate cuts in December aren't guaranteed. And this week, some commentary from officials that they're genuinely concerned about the persistence of inflation here, despite the market's complacency recently. And then on the flip side of that, we've got these renewed fears that perhaps valuations on Wall Street are a little bit too stretched. The forward price to earnings multiple, for example, is at levels that we've only seen during the dot-com bubble and during the COVID bubble. And the fact that we've had sort of some mixed earnings also overlaid with some commentary from major figures within the artificial intelligence and technology complex in the United States, suggesting that there's all these fears about excess capacity and overinvestment has really kind of taken the air out of equities. So as a result, the momentum has turned, the narrative has gone 180 degrees, and we're sort of looking at a bit of a period of risk off, it would seem.
Are investors finally waking up to just how fragile the market rally has become? You and I have been talking about it for weeks, wondering how can this keep happening? How can Nvidia get to $5 trillion after it was $4 trillion not long ago? What does the market know that we don't? And does it turn out there was nothing in it?
Well, it's a cliche, but things were priced to perfection. And I think the last few months is a great example of it really truly being the case, that it was a market being priced to perfection. So there was no room for doubts. And what we've seen enter the market this week is, again, the doubt about monetary policy going forward and the Fed's conviction to get inflation downwards. And it has to be said, there was some data released this week that kind of hinted that maybe price pressures could actually be picking up above and beyond just what was expected to be seen from the one-off hits from tariffs on prices. But then also, once again, corporate earnings, great, double-digit earnings growth expected for the S&P 500. But is the return on investment going to be there? And is this huge amount of capex that's going on in the artificial intelligence space going to be more or less backed up with strong profits in the not too distant future? So again, it's not that this is going to be the end of the world. This may not necessarily end up being a total trend reversal, but when things are priced for perfection, as I said, there's really no room for doubts, and there's just some doubts that have come in to the market in the last couple of days.
But the doubts obviously began with crypto, and then they hit over to tech, and then it hit over to gold. And all of a sudden the market gets the jitters. We're seeing some pretty big players, Goldman Sachs warning of a 10%, maybe even a 20% correction here. What's your view on that? Is this the big one, or is this just a bit of profit taking?
Well, at the moment, it could quite easily be just a little bit of profit taking. And, it is good to sort of take a little bit of a step back and remember that, really with the sell-off that we saw on the S&P 500 last night, we're really back to levels that we saw in the middle of October. So this is unwinding maybe 2 or 3 weeks of gains. However, there is very legitimate concern that perhaps we have seen a fairly significant top in the market because really we can't get any more good news than we have already received. And that once again, if we don't get the Fed cutting as aggressively as previously expected, if there is the sense that multiples are just far too high for investors to take any further risk in, that could mean that there is a meaningful drawdown upon us, notwithstanding, once again, too, some of the signs of a weaker US economy. So if I was to ascribe probabilities to it, I'd say really it's probably a 70-75% chance that this is just a garden variety pullback in what will otherwise be an upward trend. But there's a really non-trivial risk here that, once more, because of the changing policy dynamics, especially as it relates to interest rates and the lack of momentum that we're seeing here for the tech complex, this could be a deeper and more painful drawdown.
All right, let's talk about Australia, the RBA meeting this week. Inflation is still proving stubborn, as we've seen over the past few weeks. What tone are we expecting from the board?
Going forward, it's going to be very much focused on getting inflation back to target. And the question here is, as we get employment data in a few weeks' time, will the RBA lose its nerve a little bit and back away from some of the hawkish rhetoric we saw on Tuesday, or are they going to be willing to tolerate perhaps some upside to the unemployment rate, which it has to be said in the statement on monetary policy released during the week, they're forecasting not that much weakness coming through in the labour market. If that happens to occur, are they going to take the stance that no, they're steadfast in their primary commitment to control inflation, even if that means the unemployment rate ticks up a little bit? So my view is that actually the RBA has been pretty much consistent compared to other central banks around the world that have been a little bit lax when it comes to handling their inflation mandate, and said, no, we're a price targeting central bank and our job is to ultimately maintain price stability in the long run, even if that does mean the unemployment rate ticks higher because it's at an unsustainable level effectively. And that's not going to be good for households. That's not going to be good for the equity market, but it's the RBA's job. So it would seem that really we're not in for much relief going forward when it comes to interest rate cuts from an investor or household perspective. And if you do look at rates markets at the moment, that's the positioning that traders have fallen in line with, that on the balance of probabilities, we have seen the end of interest rate cuts as the markets consider it right now.
It's incredible, isn't it? Not long ago, we were talking about a number of cuts at the end of this year and potentially next year as well, but that inflation number continues to rise. I mean, a 0.5% increase in a month is a big deal. What's interesting about this is so many households have so much debt, and if unemployment goes up and if people can't afford to pay their mortgages, can't afford to pay their rent, it's not going to take a huge amount for the RBA to then have to act. It feels like, again, they're almost priced for perfection themselves.
This is the problem, is that are we going to see some kind of stagflationary light and dynamic emerge in the Australian economy, where we are getting an upward lift on the unemployment rate at the same time that inflation is above target and moving higher? And normally that stagflationary dynamic, and again, it's not what we're experiencing in Australia, but those are the two things that occur typically in a stagflation, or do occur in a stagflationary environment, is it's driven by a supply shock, that basically the supply side of the economy can't accommodate for the demand that is more or less in the economy at the same time. And the fear is that we have a supply side that is a little bit stubborn. Demand, as the RBA articulates, it's still a little bit too strong for what the RBA, for what the economy is able to produce in terms of aggregate supply, and therefore they have no choice but to hike interest rates, even if growth or at least employment is lagging a little bit. This isn't a dynamic necessarily that's just confronting Australia. We had, over here in London, the Bank of England meeting last night voted almost to cut interest rates despite inflation remaining well above target. This is a problem for global central banks, arguably a problem that the US Federal Reserve is trying to address now too, with its hot language towards inflation. But it's just really the worst of both worlds, where you do get this potential of fairly meaningful slowdown from higher interest rates that just doesn't bring inflation down quick enough, and that there's a period of pain sustained in the labour market before inflation gets back to target.
There's a lot of analysts who are blaming the tariffs for all of the uncertainty, which is jumping over to the UK and Australia as well. The Supreme Court in the US now weighing in on US tariffs. What's at stake with that decision?
It's going to be a fairly significant one. At the moment, they're just hearing it's a more or less preliminary hearing on whether these, not all of the tariffs, because different pieces of legislation have been used by the Trump administration to justify tariffs or implement these tariffs. But there are some that have been more or less implemented using the justification of emergency powers. And it's a pretty spurious argument to begin with. Some Supreme Court judges have already suggested that, okay, perhaps tariffs on China is an emergency, a bit of a stretch, but emergency because you need to protect the US industrial base. But do you really need tariffs on European neighbours and allies? Is that really justified? And is that legal? So there's two elements here. In the short term, it could actually increase a little bit of uncertainty, because the markets don't know what the actual tax and tariff policy is going to be of the White House, and that brings all sorts of unanswered questions that obviously investors don't like. But if it happens to be the case that some of these tariffs get unwound because they've proven to be effectively illegal, that this is a power that Congress has and not the executive, then that could be something that actually salvages market sentiment and pushes equity prices higher, because of course tariffs aren't great for economic activity, aren't great for growth, and seeing them removed would be basically fantastic for investors.
All right, we'll leave it there for now. Enjoy the UK. We'll talk to you again soon. Kyle Rodda, Capital.com. Thank you.
Thank you.